let's talk about the cycle of the market real time here. So everyone is seeing that the market could rally, could crash. Everyone's calling for this big, massive 2008 pushback, but not everybody really understands the economics of the entire market, right? And you can really see the flow of the market in just a couple different ticker symbols, as they call it. So these three little letter words over here: SPY, S&P 500, QQQ, and the NASDAQ, so you can track tech stocks. And then there's a couple other things out there, like the TNX that tracks the 10-year, which is the bond yields. Gold, obviously, if people are going to be storing money in there if they want a safety net and they don't believe in the economy very much. And the most important one that I really want to hit on today is the growth stocks or technology stocks that people will start to funnel into when the economic environment is in a bullish case scenario. So if we're not in a bullish case scenario, then a lot of these big hedge funds and the big banks and the big institutions aren't going to take their money and funnel back in to these tech stocks until they're ready. So what I want to do is I want to focus on looking at some of this money flow right now in just some of the prices in the stocks. So when I'm looking at the S&P 500 here, I'm looking at a daily chart, and I'm going to zoom out. I'm going to get rid of some of these lines so it's not as crazy looking. When I zoom out, these candlesticks are obviously what the price is. So 465, 348 low, and now we're seeing a nice little rally. But if I zoom out even further to the weekly chart, here's that 480 top. Here's the low at COVID. And I'm going to draw a support line right here, which is the bottom of this most recent price action. And then this is a weekly downtrend that we've been in for quite a long time now because of the economic environment. So that's a little off. Let me do this perfectly because it is right testing this trend right now. So we're really right at the top of this trend line, and we have rejected 1, 2, 3, 4, potentially 5 times. That 410 level last time was a very massive resistance point. As you can see, we rejected it, fell, had I think it was a Fed meeting, and then we rejected crazy after the interest rate hike. And now earnings season is here, and the Fed is coming up again, I believe next week or the week after. And then I really don't think that we're going to continue to rally because the economic cycle is still in that bearish/recession stage, and I don't think it's going to get much better for at least another 4 to 6 months, maybe 8 months. And keep in mind that all these interest rate hikes, we're not going to feel those effects for the next 5 to 6 to 7 months once those payments really start squeezing everybody's money out of their bank accounts. So you're seeing the SPY rally right now, but one thing that people aren't talking about is the TNX is also kind of rallying here. So it's starting to pull back a little bit. So this is the 10-year yield. The bond's obviously inverse to the market. So you'll see a little bit of a pullback, but there is a bottom right at this 34-ish level, and it's starting to bounce a little bit here. So unless it breaks this, I don't see that the market or that the bonds would continue to, or the 10-year would continue to fall. One thing I really want to point out is look at gold. Look at gold right here. Gold is soaring. So obviously, people are storing their money into gold and safety assets because they don't believe in the market right now. So this rally could just be a bear market rally, and then that rejection could come in pretty quick. What I want to point out here is the QQQ is pretty flat. So remember when I said growth stocks, tech stocks, everybody starts to invest in tech stocks and everything like that once the market starts turning around. Well, it doesn't look so hot, right? So the market is looking at a 280 right here. So this little rally that we've seen the last few weeks, everybody feels so much more bullish. This is nothing. This is nothing in the tech world. The tech stocks are not following this whatsoever. You're starting to see Amazon and all that start to get a nice little rally, but look at how far off they are from their all-time highs. 185 down to 98. So there is some buyers in there. I'm sure a lot of people are starting to, dollar cost average, get involved in some of these cheaper assets, but you're not seeing everybody rotate out of some of these defense stocks. So in recessions, McDonald's and waste management, industrials, and healthcare usually do well in recessions, right? So that cycle. In a growth stocks, everybody gonna want to be in technology, whatever. But once we start to enter a recession, people throw money into like McDonald's or Dollar General or those waste managements or anything like that that's safe in an economic turmoil environment because everybody can eat at McDonald's, everybody can shop at Dollar General because they're basically recession proof. So when I look at something like DG, it's still up here pretty nicely. So that's the weekly chart. This is the daily chart. It's seen a little bit of a sell-off, but that's only like $30. McDonald's, same situation. Around 280 was its top. It's sitting at 268. So you're seeing a massive rally. These types of stocks do really well in this type of environment. So when you're looking at something like this is how I manage a lot of my long-term stocks because I kind of follow the cycle. Same thing with waste management. I think it's pulled back quite a bit recently, from 170 to 154. But if you even look at it in the weekly chart, this thing does really well. Stays stable throughout. Pays a great dividend. So some people use dividend stocks to defend themselves in like what we're looking at right now. And then obviously energy. So energy, there's an ETF called XLE. So XLE, people put money in utilities as well in terms of economic turmoil, situation, environments, whatever. So I'm looking right now at the XLE, and I'm not seeing people take their money out of some of these safety defense stocks. Like I said, XLE, near some of its highs, right? So people are still storing their money in utilities. People are still storing their money in gold. People are still storing their money in things like McDonald's and Dollar General and Waste Management because that is a safety net. So even though we're seeing the market rally right now, it's just like almost like a facade to me. And I could be wrong here, but until I start to see that rotation out of some of these defense stocks or some of these like safety stocks, whatever it is, that is no reason for me to get involved in something like, a Square or these things are so beat up. You're seeing a little bit of a rally, like a bear market rally, but this doesn't show, it's dead. Like these stocks are dead because there's no volume, right? So there's some volume coming in compared to where it used to be, but I just don't see that rotation. Like even Apple is down here. So you see a nice little spike and people are like, oh, inflation's over. The stocks are going to come down. I don't think so. I really don't think so until you start to see like the XLE, gold, the TNX, even like oil, XOP, like XOP and ZOM, like that stuff it's still stable. Like all these places where people are storing their money until the market enters into that bull cycle again, and they can come in and scoop up some of these, more risky long-term growth assets like, like a Square or like Microsoft or Google, because these technology stocks are expensive to operate under. There's tons of technology stocks, or even like Datadog. Like this thing is getting destroyed. So there's a lot of stocks out there, and until I start to see a rotation out of these safety stocks like Cat, another one that's just rallying like crazy. So Caterpillar, great stock to determine how the economic cycle is doing. So if you understand which types of stocks, defense, healthcare, consumer staples, utility sector, like those four sectors do really, really well in economic environments like this. And then once we start to go down in terms of inflation, deflation, whatever, once we start to like level off and we start pulling back interest rates, you'll start to see these defense stocks, utility stocks, healthcare, industrials, they'll start to go down, and you'll start to see the funnel of the money go up on the tech stocks and growth stocks. So that's when you start piling into things like Datadog, Square, Apple, Amazon, all that other stuff. So you're seeing people buy right now, but I think it's just a bear market rally until I see people rotate out of the other money. So don't just look at these prices going up and think, I need to get in right now because it's up like crazy. It's up 10, 15% in the last 4 or 5 days. Use the market for what it's for. Watch the different sectors and watch big money rotate in and out of these. And then at that point, that's when you can capitalize on your entry points to invest for the long term. So the economic cycle is hard. I hope that helped out a little bit. You can ask any questions you need in the comments. I know a ton about the economic cycle and all this other stuff, so I can start to put together a list of what stocks to look for in different sectors. So if you saw any value in this, give me a like, give me a comment, maybe a subscribe. There are more economic videos for this to come. I can explain in further detail, but so I don't bore you to death, I hope that this is a great intro. And like I said, any questions, let me know in the comments.